Silver investors? Mainstream finance just ran a headline. Can silver reach $200 in 2026? The answer might shock you. Their answer is no. And they base it on history and the hope that China quietly turns the tap back on. Right after a 144% run, export controls, and a 36% crash reset the board. I'm OG John AG, and in this video we're going to break down exactly what this article gets right, what it completely misses about silver's new role as a weaponized industrial metal, how China's export chokehold and Trump's April visit actually raise tail risk, not lower it, and why a 36% drawdown after a parabolic year tells you more about leverage than it does about the ceiling for price. Segment 1. What actually happened? 144% up, 36% down first. The facts they give you. According to the article, in 2025, silver surged 144%, driven by investors hedging rising political and economic uncertainty. Fear of a looming supply shortage after China announced new export restrictions. Silver broke $100 for the first time in history, peaked around $120 per ounce, has since fallen 36%, trading near $77 at the time of writing. So we're not talking about $20 to $30. We're talking about a once-in-a-generation breakout through the old 2011 high, then a violent reset that took roughly a third off the top. The question they pose, is this the ultimate buying opportunity before a push to $200 in 2026, or the top of a blow-off that leaves late buyers trapped? Their conclusion, history says downside is more likely than upside from here. Let's see how they get there. Segment 2, their core thesis, history says be careful. The author leans on three historical arguments. Silver's long-term returns lag gold. Over the last 50 years, silver has returned an average of 5.9% annually. Gold has averaged 7.5% annually. Translation: silver underperforms as a long-term store of value. Silver's drawdowns are brutal and slow to recover. After peaking in 1980, silver lost more than 89% of its value. It took 31 years to reclaim that high. After a new record in 2011, silver dropped 71%, and investors waited 14 years to see that level again. Silver behaves like a high-beta industrial metal, not a safe store of value. The article calls silver far more volatile than gold. It stresses that investors have suffered holding direct metal or ETFs like iShares Silver Trust, SLV, through full cycles. From that lens, the author answers the headline, with silver already up 144% in 2025 and only 36% off the peak. With a 50-year track record of gut-wrenching drawdowns and slow recoveries, the odds of a clean rally from $77 to $200 in a single year look low in his framework. He adds a macro wildcard. If China loosens export restrictions, the supply squeeze narrative dies, and that could almost certainly trigger an aggressive sell-off. So his bottom line is, I don't think silver will stage a further rally to $200 this year. In fact, history suggests further downside might be more likely instead. That's the mainstream view. Now let's talk about what that view leaves out. Segment 3, China's export chokehold. Leverage, not comfort. The article's main fundamental point is actually crucial, and he's right to highlight it. He notes, China is the world's second largest exporter of silver. In December, Beijing announced new export restrictions to limit how much domestic producers can sell globally. Those restrictions took effect January 1, 2026, and are scheduled to last until end 2027. The motives he lists: protect domestic supply chains. China is a top electronics manufacturer. It wants to stockpile raw materials like silver for local use. Geopolitical leverage. By restricting exports, China gains bargaining power in trade negotiations with the US and Europe. It can potentially trade silver access for relief on other barriers. That's all correct. Where the article takes comfort, I see tail risk. He argues, if China loosens restrictions, supply normalizes, silver sells off. President Trump is scheduled to visit China in April, and trade talks are on the agenda. Implicit assumption, China and the US quickly find an accommodation. Export restrictions soften, the scare passes. But export controls like this are rarely announced, implemented on Jan 1, then casually reversed 3 months later because one foreign leader visits. What we actually have now is a formal multi-year policy through 2027 that constricts silver exports, explicitly tied to China's long-term industrial strategy. Trump's April visit doesn't remove that risk. It makes silver an explicit bargaining chip at the table. That isn't comfort. That's weaponization. If talks go badly, silver isn't just a commodity anymore. It's a lever China can pull with immediate global impact on a metal that industrial supply chains now depend on. Segment 4, the industrial backbone. Why this isn't 1980 or 2011. The bearish history lesson treats silver like gold's little brother with more volatility, a speculative hedge that overshoots and then bleeds for decades. But even the article admits something that makes this cycle different. Over half of its total annual supply is soaked up by manufacturers every single year. He points out silver and gold share, high conductivity, rust resistance, malleability, but gold is too scarce and expensive. 216,265 metric tons ever mined, about $5,000 Aussie, to use broadly in industry. Silver is more abundant. Around 8 times more of it is mined each year compared to gold. Historically formed a reliable supply chain, is therefore far more affordable. Result? Manufacturers soak up more than half of silver's annual supply every year for electronics, alloys, solders, other industrial products. That's fundamentally different from the 1980 and 2011 peaks the author leans on for his warning. Back then, industrial demand was a meaningful factor, but today's stack, solar, EVs, data centers, high-frequency electronics, simply did not exist at this scale. Now add China's export restrictions through 2027 on top of that industrial growth. So the setup is more structural industrial pull than any previous silver bull, plus a formal state-level export choke from the world's #2 exporter in a world where silver is increasingly treated as a critical input, not a speculative side bet. History is useful, but when the underlying use case changes, you can't just copy-paste the last 50 years and call it a day. Segment 5, the 36% crash, leverage flush versus ceiling. The author leans heavily on the 36% drop from the $120 peak as evidence that $200 is unlikely. But look at what we actually know from his own numbers. Silver was 144% in 2025, then 36% from the peak, still up massively versus where it started that run. This is parabolic move math. A 144% rally turns $50 into 122s. A 36% drawdown turns 122 into $78. You're still up more than 50% from the starting point. The crash tells you leverage was extreme at $120. Late-stage buyers got torched. It does not tell you that $120 is a hard ceiling, or that $200 can't be reached in a different leg of the same cycle after. Positioning resets, new catalysts appear. Physical deficits worsen under export controls. In other words, the 36% drawdown is a positioning story, not necessarily a valuation story. When you combine a structural industrial shift, multi-year export restrictions, ongoing inflation, and currency questions, you can absolutely get multiple waves in the same bull market. One topped at $120, the next doesn't have to respect that line. Segment 6, Trump in Beijing. The risk nobody pricing $77 wants to talk about the article's key timing data. President Donald Trump will visit China in April. He'll meet with Xi Jinping. Trade talks are expected to be on the agenda. The author uses this to argue, if China loosens export restrictions after those talks, silver could sell off hard as the supply scare fades. Fair. But there's a mirror image of that scenario that isn't even mentioned. What if talks go badly, or deliver nothing concrete, or escalate existing tariff and tech disputes? In that world, China has every incentive to keep restrictions in place, or even make them stricter, turning silver into a more explicit geopolitical lever. That doesn't guarantee $200 this year, but it does mean the right tail of outcomes is fatter than a simple mean reversion chart assumes. You can't talk about the shock of $200 in 2026 without acknowledging a sitting U.S. president is about to walk into Beijing while a critical industrial metal is under export controls until 2027, and both sides are openly using trade tools as weapons. History can't tell you what happens when a 144% run, a 36% crash, export controls, and a Trump-Xi summit all overlap in a single calendar year. Segment 7, the store of value critique and what it misses. The author's final big argument, silver isn't a great store of value. He backs it with 50-year returns, 5.9% annualized versus 7.5% for gold, long, painful bear markets after peaks. For a passive buy-and-forget investor, that's a valid caution. But 2 points. Cycles, not averages, are what matter in a metal like this. The people looking at $200 aren't trying to hold 50 years. They're playing cycles driven by monetary policy, deficits, industrial bottlenecks, geopolitics. Volatility is a feature for active capital. The same volatility that makes silver painful for set and forget is exactly what makes it interesting for hedge funds, macro desks, active individuals. Silver's long, ugly sideways stretches do not preclude sharp, explosive moves when multiple drivers align, and we are now in a regime where industrial demand is structurally larger, export controls are formalized policy, macro uncertainty is not shrinking. So yes, history says silver can destroy anyone who treats it like a savings account, but history does not say, post $120 in a world of export controls and Trump-Xi brinkmanship, $200 is off the table. That's an extrapolation. Segment 8. So, is $200 possible in 2026? Here's the straight answer based on the article's own data and what it leaves out. Silver at $77 after a 144% run and 36% drawdown, with export controls locked in through 2027, a U.S. president heading into high-stakes talks in April, over half of annual supply now hardwired into industrial demand, does not make $200 the base case for this year. The move from $77 to $200 in 12 months would require either a massive supply shock or a monetary geopolitical accident big enough to slam the dollar, ignite safe haven demand, and keep China's grip on exports tight or tighter. But it also means this. Treating $200 as impossible because of 1980 and 2011 ignores how much the real-world role of silver has changed. Treating $200 as guaranteed is fantasy. The real takeaway from the article isn't the conclusion, it's the inputs. 144% up in a year on supply fear and hedging. Export controls through 2027 from the world's number 2 exporter, a 36% flush that cleaned out leverage, a Trump-Xi summit with trade and silver in the background. That's not a stay-away setup, that's a know what you own, know the range of outcomes, and don't confuse a positioning flush with the end of the story setup. You've been watching John AG here, and I'm OG John AG. If this helped you see what an AOL Motley Fool $200 silver article actually says, and what it carefully avoids saying, hit like so this doesn't get buried, smash subscribe with all notifications on, and drop a comment. 77 sellers after $120. Are you pricing history or this cycle? Tell me whether you think silver's 144% run and 36% crash were the end of the move, or just the first act in a cycle where export controls, industrial demand, and great power negotiations decide what impossible really means.